Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Is the short-term real estate market in a bad situation? Are they going to drive up the inventory? There's something floating on social media that's trending that we need to address. Inflation data came in this morning, as expected, showing that inflation data has continued its decline throughout the first half of 2023. Is the Fed still going to put the kibosh on this rally and tighten interest rates and strangle the economy? Let's get right into it. So the first thing that I want to address this morning is something that was trending on Twitter and social media pages. It was referring to short-term rentals, specifically on Airbnb. I'm assuming, since I've looked at some of the other data and some of the other short-term company real estate organizations that have short-term rentals listed on their platform, they're going to be very similar data. So let's address this one, the one that's trending. I'm going to pull this up for you. Let's take a look at it. It's two data points by two different organizations. Well, one data point by two different organizations. All the rooms on the left, and then AirDNA data on the right. I want to highlight that last column on each side, that percent drop with all the rooms and percent change with the AirDNA data. Percent drop, percent change, or essentially in this situation would be the same metric because they're both down. I mean, there's a couple ones in there that are up on the AirDNA data, but generally they're all, look, majority of them are down. So let's start in that left side, all the rooms, that percent drop. It starts at negative 47.6%. Next one below that with Phoenix, Arizona, down 47.2%. And then so on and so forth. Big number drop year over year in how much revenue per listing they're bringing in on a monthly basis. And it's huge. And then on the one on the right, nowhere near anything like that with the AirDNA data. Down 9.4%, down 3%, down 7.2%. Same cities, huge difference. What's going on? I'll tell you what's going on. It's pretty simple. On the one on the left has a different data metric. The one on the right has a different data metric, but they're very similar. So let's start with the one on the left. It has a mix of two data points: full-time short-term rentals and part-time short-term rentals. Let's break that down real quick. Assume that I have two houses. Let's take a look at that second house is 100% Airbnb rentals, 100% short-term. That's all I use that second house for. I don't live in it. My grandparents, my mom, my grandparents, cousins, aunts, uncles, whoever, they don't live in that. I'm just using that for short-term rentals. That's full-time short-term rentals. All right? Let's take a look at the other situation. I own that second house. I live in it 6 months out of the year. The other six months, I rent it out on Airbnb. There's a huge difference on the revenue generated from that, right? One time is 100% on there. The other one is part-time. And that's on all the rooms. So it has a mix of both short-term or part-time and full-time Airbnb, short-term rentals. On the AirDNA data, that has just full-time Airbnb rentals. Of course, they're going to be different metrics. Huge difference. One's got half time, or I'm partially doing it, but I'm living in it 6 months out of the year. Other one is just all completely for short-term rentals. That's the purpose of that property. That's the purpose of that investment. All right, so you can see why there are huge discrepancies. That the one on all the rooms was trending, and it's showing a huge collapse, down 47%. That's insane year over year. But that's not really the case. It has, and now you can see that there's other data points, other things under the hood on that metric compared to the other one. Now, let's dive into that AirDNA data point. I mean, it still has a pretty significant drop. The first one's down 9%, down 3%, down 7%. Those are still, that's taken away from your profit. If I bought my property in 2021 at high interest rates, where interest rates were coming up at a high interest rate, high valuation, and all of a sudden my revenue's coming down at the same time, you're seeing housing prices nationally coming down. Obviously, city specific, each city is a little bit different, but as the U.S. nationally, it's coming down. And even by cities, most cities are still coming down, just in a different time frame. But they're coming down slowly. So if I'm losing revenue from my Airbnbs and then I paid a high price for my property and it's starting to come down, that's really going to put a strain on my cash flow coming from that property. And cash flow is how much, how much renters are paying me for their short-term stays. So you can see where it could be a problem. Is it dramatic as what that trending data point was? No. Could it be a problem in the future? For sure. There's 1 million people that have their houses, their investment properties listed on Airbnb. And then there's a bunch of other platforms that their houses are listed on. So it could be a problem in the future. Is it screaming right now in our faces? No. No. So it's undue panic when we see those. So that's really what's going on there. Let's shift gears and talk about this low inflation data point here. And at the same time, we'll address what the Fed is saying. So we had low personal consumer expenditures, one of the Fed's favorite inflation metric. They highlighted every meeting they've had in the last year since they started raising rates in March 2022. And it came in lower than expected. Well, not lower than expected, and the consensus was as expected, but a lower than expected, and a lot of economists were expecting it. So let's say it came in as expected, but it's still showing this decline throughout the first half of 2023. And the Fed went in front of Congress. He testified. Fed official Jerome Powell, he's the president, and he said inflation's too high, expect 2 more rate hikes. Well, the bond market, interest rate market, didn't really respond to that. I mean, take a look at this. Right in front of you here, you have the 30-year mortgage interest average throughout the United States. This is a data point by the St. Louis Fed. It hasn't really moved. It's sticking where it has the last month or two. I mean, it's had a tiny bounce when he first had that speech, and it's really been on the decline following that. It's sitting around 6.71% as of close of business day yesterday. So the Fed has said, hey, we're going to raise rates 2 more times, but at the same time, they said they're going to be data dependent. If the data says that they don't need to raise rates, do they need to raise rates? No, because the inflation's coming down. So they don't necessarily need to we can never be 100% of exactly what they're going to do, what's in their minds. But if they're looking for a reason to raise rates, they don't have one from this inflation data point. Are we going to have another inflation data point before their next meeting? You bet. The CPI, Consumer Price Index, another inflation data. If it comes in super hot, will it get their cover to raise rates? Perhaps. But we've seen the last few data points of inflation, it continuing to come down, and giving them the reason to not raise rates and just pause and sit tight and let their historic rate-raising campaign that started March of last year until last meeting in early June, they hiked it very, very fast. So let's see it play out unless we start getting some hot inflation data. And they also, keep in mind, said this, that one data point doesn't mean things are changing one direction or the other. So we can't just say, hey, we got one hot one, we need to raise rates. It might take a multiple of hot inflation data before they hike rates again. And again, the interest rate market is telling us that they're probably not going to raise interest rates right now. We start to see that change because of hot inflation data. That's a whole different metric that we have to take a look at and have to be aware that things can change. This is not a very straight line situation. It's fluid, it's evolving, and we just got to be aware of it, and we need to be flexible with our investment decisions, and that's okay. Okay, shifting gears. What's going on this week? We've had a really, really solid week in the market. Let's take a look at the S&P 500 real fast. And we know we're up as of 9:41 this morning, 2.11% these last 5 trading days. So a solid run in the market this last month. Again, seasonality is playing against us. We've had a major run in the large tech stocks. So, bear that in mind. Is there still opportunity out there? Absolutely, but you need to realize seasonality, realize a lot of this inflation data coming down has been priced into your stocks. So, if you have some major gains because of seasonality, might be best to lock in some profits on some of those things. But again, always consult your financial professional and consult your investment plan. If your investment plan is just buy, hold, stick with that. If your investment plan is to buy and homework, be flexible, stick with that. Have a plan in place through these times and realize seasonality for the summer months are generally down. We've had a big rally. It's always nice to lock in some profits and take some of your gains, but everyone's situation is different, so always keep that in mind. If you found some value from this video here, please do me a favor, like and subscribe. Stick around for next Friday's market forecast. Well, we'll see the full ramifications from this lower than expected or as expected inflation data. And because sometimes you don't necessarily, the market may react, but you don't necessarily know how the market has responded. It takes a couple trading days to digest. So tune in next week. We'll talk about it. And thank you very much for joining. Expertise you deserve, experience you can count on.